So I believe that's a little bit too high number, right? But coming back to the problem of the discount rate. Right, don't worry, like basically the next 3 chapters is everything, all the time that we spend in the next 3 chapters will be focusing on this problem of the discount rate. So we come back to this. Good. So I think this is a neat application of a simplified formula and already highlights kind of what the problems in valuation are. You have to make forward-looking estimates, and there are choices related to that. And the good thing for you is that it's not 100% right or wrong, but you should always have a good reason why you're doing things, and not just do it randomly. Okay, so that finishes the part on the present value method, or discounted cash flow method. Now let's switch gears and look at the next pricing principle. And again, I start with a couple of definitions first. So a key object of interest here is a trading strategy that we call arbitrage. It's a term that's commonly used in practice. So basically, it's a trading strategy aimed to take advantage of price differences. Right, a very simple example might be that you have shares of Daimler trading at different exchanges. Maybe it trades in Frankfurt and trades in Berlin. And suppose the price is different. Maybe it costs 75 in Frankfurt, but only 74 in Berlin. What would be a trading strategy if you observe this price difference? Well, you would like to buy there where it's cheap, so you buy for 74 in Berlin, and you immediately sell in Frankfurt. Right? You can transfer this electronically, that's not an issue. Right? And you can immediately pocket a difference of €1. Right? You pay 74, you sell it for 75. And in general, in practice, this term arbitrage is used for any of these trades that may take advantage of price differences of basically the same good. It can be financial assets. It's also quite common with commodities. It's a little bit more complicated for commodities because they're at different places in the world. So you have prices, say, for coal in Germany or Europe. So it's basically the most liquid trading point in Europe is the Amsterdam harbor, because that's the biggest import harbor. And then you have, I think, three or four prices in the world where coal is exported. So it usually comes from Australia, from Bolivia, and from South Africa. So these are the 3 nations that export coal. Well, there are other countries who have lots of coal that we don't import from them, so we stop importing coal from Russia, and the US doesn't export. So, but these are the biggest 3 exporters. So you can observe the price for coal, say, in South Africa, in Richards Bay, in the harbor, and you can observe a price in Amsterdam. What's more is that you can actually observe traded prices for the shipping, right? So there's dry bulk ships, and there are financial contracts on these ships. So you will see a price difference between the 2 harbors, but the question is, are they higher or smaller than the transportation costs, basically? So arbitrage and these trading strategies can be done with physical assets, but you would have to incorporate location and time for transportation to do so. So in practice, it's a pretty widely used term. And I highlight this here because we use it here in this class with a much stricter definition. And for us, an arbitrage trading strategy must meet the following 3 criteria. So the first thing, it must be profitable, which is hopefully obvious that you don't want to do something that's creating losses for you. The second thing, it should be totally free of risk. And free of risk means in this case that there is a 0 chance that you make losses with this. You can have with 0 profits, that's fine, but you never make any loss on these transactions. And never really means never, right? So not, if there's the slightest chance of this happening, it's not an arbitrage according to our definition. And the last thing is that you shouldn't need own capital to do it, so it should have 0 cost for you to do. Going back to the example with the share price in Frankfurt and Berlin, this definition here now would make a very strict restrictions on this trade. So first of all, the prices that you observe in the exchanges are not the prices that you can usually trade on. They're the last prices, right? So 2 people meet on the exchange and they trade. There's always one seller, one buyer, and that's the price they've agreed on. It does not necessarily mean that the next transaction that you enter will be at the same price, right? So you have to make the assumption that those prices persist in the market. The next thing is, well, how do we get this risk-free? So basically you would have to do this simultaneously at the same time, right? Because if there's a time delay, so you buy in Berlin, and then you wait, even if it's just 10 seconds, the price in Frankfurt might have changed, right? So it must be really at the same time. And finally, there shouldn't be any kind of own capital involved. That means if you don't do it at the same time, you would have to buy first in Berlin. That creates a cost for you, right? You have to put up the money for purchasing. So there are now two things. So either you say that you borrow the money for this, then you would have to incorporate the cost of borrowing, like your interest. Or you would really have to say, like, I do this so quickly, simultaneously, that the money that I have to pay is directly coming from my sale in Frankfurt, right? So that's settled kind of at the same time, you can realize that. Right? But you see, these are very, very strict assumptions. So the 2 and 3 are important. Zero cost, no initial capital. And they should be risk-free. So that means that you never lose, right? Never lose. In comparison to that, the strategies that you see in practice are often involving small amounts of risk, right? They're never completely risk-free, that would be my argument. Right, so there's something like merger ratio arbitrage. That's a popular strategy by investors. So what they do is if two companies want to merge, and usually they announce it and then they start negotiations. But it's not clear how much of the combined company will be owned by the old shareholders of the first company and the old shareholders of the second company. Right? So usually they, in the negotiations, agree on an exchange price. That means the first group of shareholders, they get 50% of the company, the others get 50%. Right, and typically the two firms who participate in this don't have the same value, right? If they have a 50-50 share afterwards, and one company is worth less than that, that means their value increases. The other company must have a higher value then, so their value is going to decrease. Right? So merger ratio arbitrage means that you buy the shares of the company that is going to appreciate in value, you sell the other share, which will go down necessarily then. And then you hope that your estimate of the price is right, and the two prices will converge, and you make a profit of this difference. The problem here is absolutely not risk-free, because you don't know what the exchange ratio will be. That will be the outcome of the negotiations. So you're betting on a certain thing happening. It's called arbitrage in practice, but it isn't according to our definition. It's risky. Right, there are several other strategies, convertible bond arbitrage and so on, which are done by hedge funds. They usually involve risk. There's some more terminology around this, just that you have seen this. There are two archetypes of these strategies. They're commonly used terms here, free lunch and free lottery. So basically this is about when do you get the profit from this. So just literally like interpret the words, right? When you have a free lunch, you eat the lunch immediately, and you walk away without having to pay for it, right? Because it's free, right? So that basically means that you get the profit immediately. Right? The profit occurs immediately, it's a free lunch. Another example for the free lunch would be something like you find money on the street, like you walk the street and there's a bill, say it's 20 euros. Now, of course, real life is a little bit more complicated than financial markets, so of course you would look around, is there someone, some people, if they find large amounts of money, are so honest to bring it to the police, right? There was a football player losing like 20,000 or so euros in a cab, and the cab driver was so honest to bring back the money, right? So these things happen in real life. In the financial markets, actually, they don't. So we believe that people pick up the money and they walk away, right? So the financial markets are a little bit more ruthless. So finding money on the street is a free lunch strategy. And I'll come to the point that actually these things shouldn't happen in financial markets. The next strategy will be a free lottery ticket. Right? So you don't have to pay anything for it, but at some point in the future there is the draw of the lottery. You never lose on your lottery ticket, right? So the worst thing is that you get 0. But you will have some positive probability of winning the jackpot, right? So you can only win but never lose. Right? So this is even involving probabilities, right? So arbitrage can be profit that you don't make all the time. It can be just with a positive probability. However, the probability of losses has to be strictly zero. Right? You never lose money on your lottery ticket. If it's for free, you have zero cost. So for the free lottery, usually the profit occurs at some point in the future, while the free lunch would be the profit today.
Can I ask something?
Yes, sure.
But if there's a profit in the future, but there should be any discount rate. So maybe if I receive the same money in the future, or I receive more money, but it will be less than the discounted amount, will it still be a profit? Or
Well, this is an archetype, a special time where it's completely free. But yes, in general, your idea isn't bad, right? So you can have, it would work with that as well, but it must be a profit. It can never be a loss. That's the important part. And you can discount the profits if you want, that doesn't make a difference. Okay, so why talking about these things which seem to be so oddly specific here?